Welcome to CFTC Talks. I'm your host, Andy Bush. Hey, remember you can get the podcast by going on iTunes and searching for CFTC Talks, or you can listen to the podcast by going on our website, cftc.gov, and click on the podcast button. By the way, there's an important disclaimer at the end of the podcast you should hear. This week, we dive into the critical world of banks and how the U.S. ensures banks stay safe and sound. Joining us on the show today is Acting Comptroller of the Currency, Keith Noreika. Keith, welcome to CFTC Talks.
Thank you, Andy. Glad to be here.
It's a pleasure to have you on. Before we jump into what the Office of the Comptroller of the Currency, let's talk a little bit about your path to this role. Your education rolls from Harvard Law degree to the editor of the Harvard Law Review to getting your bachelor's in science from Wharton. And you've taught at the University of Pennsylvania and University of Virginia. Like all education, it's cumulative, but what stands out in your mind from these experiences?
Well, Andy, I've been fortunate to have a very successful career in the private sector and to teach promising law students and now serve our country in a very important role. Surely editing the Harvard Law Review was a highlight of my law school experience, and professionally, I've worked with a number of real thought leaders in the banking realm before and during formative moments of the industry for the past 20 years. And one of the lessons of that experience is that the federal banking system really is a source of strength for the nation and the economy. And when it runs well, it powers tremendous growth and economic prosperity for consumers, businesses, communities all across our country. And our challenge now is to find a balance where supervision effectively ensures safety, soundness, and compliance, but doesn't stifle opportunities through unnecessary burden or foster an environment so risk-averse that banks fail to meet credit needs of their customers.
Right. So for our audience, can you take a moment and explain what your agency does and why it matters for the health of the financial system?
Well, there's a lot to learn when it comes to our nation's financial system. Banking is just one segment of our industry.
Certainly.
And it's very complex with federally chartered banks that our agency regulates, state banks regulated by the states, and on top of that, you have the Consumer Financial Protection Bureau writing, enforcing rules on consumer protection laws, the FDIC ensuring deposits, and the Federal Reserve regulating holding companies and setting monetary policy.
So the OCC occupies that space of overseeing and regulating the national banking system. Mm-hmm. So, okay, that's my understanding of it. And I also noticed that, and I have to ask you about this, I see that you're acting chairman of the agency. What's the difference between acting chairman and actual chairman?
Well, the Acting Comptroller of the Currency it has all the same powers and authorities and responsibilities under the National Bank Act as a Senate-confirmed controller. The one real difference is job security. I will only serve until the 31st Comptroller of the Currency is confirmed and takes the oath of office, and then that comptroller will serve a 5-year term.
I see. So it's a 5-year term. All right. Well, let's get to the meat of what the OCC does. How's the health of the federal banking system and with that, the U.S. economy?
Well, I appreciate your mentioning that. The health of the federal banking system is strong. We are in a gradual recovery for 9+ years, and we see a lot of positive in today's economy. And as I said, the banking system continues to be fairly healthy. I think the challenge, as I mentioned earlier, is finding ways to reduce burden and take better opportunities to grow the economy, which would be good for everyone. And that's what we're looking at doing right now.
Okay, I understand. That's obviously that flows out from the executive orders from the Trump administration, certainly. And you guys took part in, and I assume you were part of the Treasury report that came out on looking at financial regulation.
Well, we had input on it.
That's what I mean.
Did all the agencies.
Right.
There are statutory firewalls between us and the Treasury. So
Right.
even though we're a bureau of the Treasury and have been for the last 154 years, I mean, just so your audience knows, the OCC dates from Abraham Lincoln, and that is the statute actually that I'm here under, is one signed by President Lincoln in 1864. But even though we're part of the Treasury Secretary cannot dictate the day-to-day activities of our bureau. That's for the Comptroller of the Currency to do. So while we had input, we have our own obligation to come up with our own statutory and regulatory proposals, and we did just that, testifying in front of the Senate Banking Committee on June 22nd, where I had a number of legislative proposals that we think can reinvigorate the banking sector and reduce unnecessary regulatory burden and overlap.
Well, since you brought that up, and your testimony, you're focused on reducing regulatory burden and promoting economic growth. Why now, and why is this a priority?
I've been practicing in this area for the last 20 to 25 years, and I think usually every 5 to 10 years there is a bipartisan recalibration of the banking laws. What we're seeing here is we regulate a dynamic industry that changes over time. The regulation has to keep up. Much of that regulation is set by statute. The statutes then have to change. And some things are enduring. Like, as I said, our statutes date from 1863 and 1864.
Right.
But those also occasionally have to be changed over time. There have been other statutes and agencies added in the time that's come, and some have been added and also disappeared. But I think generally there is a bipartisan consensus every 5 to 10 years where everyone stops, takes a look, they see what works, what doesn't work, and they recalibrate so that the regulation can be effective and efficient as well.
Well, where do you think are the best opportunities?
Well, I think there are a number of opportunities, and a lot has to do with, the financial crisis came around. There was a reaction to it by the enactment of Dodd-Frank in 2010. I think some of that, now we're getting experience in 10 years of looking at it to see what can be done better or what didn't work. And I think a lot of the main things that come to my mind are, in the banking realm at least, there are so-called statutory thresholds. When a bank or bank holding company gets to a certain asset size, like 10 billion or 50 billion, they cross certain thresholds where a lot more regulation comes into play. And what I am seeing, at least, both as a private sector lawyer on Wall Street and then now here in this position, is those, like a lot of regulation over time, the regulation itself becomes a competitive barrier to entry. So the people who are on the one side of it use it as a way to create sort of a monopolistic or oligopolistic position where they have so-called monopoly rents, if you know anything about economic theory.
Sure.
And the people on the other side, it's very hard to cross because you have to ramp up your scale a lot just to get over the barrier. You can't just cross the barrier. You got to really cross the barrier, and that becomes very challenging. So like at $10 billion, if you are $9 billion, it's not like you can just go to $10.1 billion. You need to go to 20. So that's like over doubling your size to get the type of scale to amortize the costs of the additional regulation, because you're going to be at a competitive disadvantage. And what you're seeing at the $50 billion mark is that the largest banks that are in the $1 trillion and $2 trillion asset size, they're about 30 times or more larger than the $50 billion bank that bears, comparable cost of regulation. So they have a lot more assets to amortize the cost of the regulation. And what we're seeing, even though the $10 billion is really hard for community banks to cross, the 50 is almost prohibitive. We've only ever seen 2 banks cross it, and one fell back after it crossed it because of that challenging condition. So, people complain about banks being too big. Ironically, Dodd-Frank now is acting as a barrier to have competition to challenge those banks. It's actually keeping them too big.
Wow, that's fascinating. So is this thinking, would this also explain why we've seen so few de novo banks created in the United States?
Well, that's another problem entirely. That really results from the fact that to get a de novo charter in today's world, you need to go to not only the chartering authority like the OCC or the state regulator, but you also have to go to the FDIC as well. And the FDIC, since 2008, has only granted about 4 or 5 deposit insurance applications. And we've had a really hard time, and we've proposed a bill that would go back to the pre-1991 rule that would allow, when the OCC charters a bank, to certify that the deposit insurance factors are met and deposit insurance to come. But we ourselves, since 2001, have chartered 14 institutions, and the FDIC hasn't acted on any of those 14 applications. So they didn't even say yes or no. They just let it hang out there forever so that the organizers wasted all their money trying to get insurance, and then they gave up. And to me, that's unconscionable for a regulatory agency not to give you a yes or a no that you can challenge under the Administrative Procedures Act in court, but instead just to let you hang and use all your money. So that primarily, to me, is the number one reason why you're not seeing any de novos in the country today, because people on the other side of it now are like, that is just a path that's closed. We're not going to waste our money on it.
Well, it's interesting, too, because with that going on, then this really wonderful new development and innovation that's going on in the fintech space is got to be a positive to some extent for the financial industry. And I know on July 19th, you gave a speech to support responsible innovation in fintech. For the audience, the OCC launched its innovation effort in 2015 and created the Office of Innovation, kind of ahead of its time a little bit, I would say. So in that vein, how will your agency support this responsible fintech?
Well, look, we have a number of charting options, even under statute, for limited purpose banks that may not need insurance, or that we can rearrange existing banks that can meet the fintech needs, as well as a regulation potentially, although we're not really using it at the moment, that could grant fintechs charters to be non-depository banks. So we have a lot of options. My own view is, though, fintechs and community banking aren't mutually exclusive. I think they're actually quite necessary to one another, that the real sort of salvation of community banking in the future is to adopt fintech to become, incubators of innovation. And that's really not only will revolutionize the industry, make it more dynamic, but also really increase competition that will challenge, the larger banks to be better and ultimately maybe make them a little bit smaller and more manageable.
Well, I think for the community banks, it certainly on the fintech side, it helps them compete, obviously, because they don't have to hire these huge compliance teams, especially in the reg tech, when you get into that. And if they do partner up with fintech companies, it helps them offer services perhaps where they couldn't in the past because of the additional costs associated with that.
Yeah, it goes both ways. I think in some ways what we see, in addition to regulatory burden, the two sort of biggest fixed costs that need to be amortized over asset size are marketing expenses and technology expenses. So in some ways, the smaller banks may be disadvantaged. On the other hand, it may be the one way, or a very promising way, I should say, that small banks can challenge larger ones if they, have an idea that they can use and corner the market in, so to speak, to get a good competitive position. That may be their salvation, their road to, to really a good American success story. I think on the regulatory side, reg tech or compliance, I do think technology does have the innovation to bring down costs to make regulation and compliance on both sides, both the regulator and the regulated entity side, more effective and efficient.
So wrapping this up, back to, why does this matter? I mean, how does this impact the consumer?
Well, look, I think ultimately the consumer is the beneficiary or detrimentary of what banks can offer them. They buy products and services like we do from any business. And so even though banks may be regulated differently because a failure of a bank may present systemic risk, that's the whole reason why it's a different system of regulation than a commercial company. I think at the end of the day, you have to remember that banks provide products and services to consumer like any other company, and the more they can offer them in new ways that meet their needs in a changing and dynamic marketplace at lower cost, the better off we all are.
All right, Keith Noreika, Acting Comptroller of the Currency, thanks for coming on the show today.
Happy to do it.
Hey, that's it for me this week. Remember, you can subscribe to the podcast by going to iTunes and searching for CFTC Talks, or you can listen to the podcast by simply going to our website, cftc.gov, and click on the podcast button. We'll be back next week with another guest for our quest to learn about the markets that we watch. I'm Andy Bush. Thanks for listening. This has been CFTC Talks. But wait, there's more. Disclaimer time! The CFTC is providing this information as a public service and is neither a legal interpretation nor a statement of CFTC policy. Reference to any specific product, service, trademark, manufacturer, or service provider does not constitute an endorsement or recommendation by the CFTC. The CFTC is not liable to any consumer or third party for any direct, indirect, incidental, consequential, special, or exemplary damages or lost profit related to the use of the information provided or referenced in the podcast. Selection of guests on the podcast does not imply an endorsement of any particular individual or entity. Many individuals and entities provided similar services to those of the guests. The views and opinions expressed by the guest in the podcast are their own and not specifically endorsed by the CFTC. Moreover, the information provided in this podcast should not be construed as investment advice. Consumers should rely on their own inquiries as to the accuracy and relevance of the information incorporated and referenced in this podcast and assume the entire risk related to its use. The CFTC is providing this interpretation of market trends solely to inform the public of a framework for projecting future outcomes under different scenarios. If you have any questions concerning the meaning or application of a particular law or rule administered by the CFTC, please consult with an attorney.